If you're a beginner investor or even an investor who is looking to switch up and update your strategies, then you're watching the perfect video. Investing blindly is the quickest way to lose all your money. That's why it's so crucial to have an investing plan. I'm going to take you through my ultimate 2023 investing plan, my reasons, and why you should consider doing the same. P.S. I'm going to take you through the exact percentages to dedicate to different areas of investments, so be sure to stay tuned for that. So first things first, we all want to have more cash this year than we did last year, and to do this, we need to set up a cash portfolio. Right now, there is a lot of uncertainty in the markets, especially with what the FED is going to do. We know that the FED is trying to increase rates through the first half of 2023, which means that money is going to be a lot tighter than before. But by having cash in your portfolio, you will be able to wait for opportunities in the market to arise as soon as the FED announce that they are going to stop the interest rate hikes. So in my portfolio, 30% is going to be dedicated to cash. One of the biggest chunks of my investable assets is ETFs or exchange traded funds. These are the foundation to my portfolio, or any portfolio in my opinion, and they're basically going to plug and chug at an average rate of return of around 7 to 10% every single year. If you stay invested in an ETF over a long period of time, especially one that tracks the S&P 500 market, it typically averages about 7 to 10%. If you're sitting there and you're like, okay, what is an ETF and what does it actually do? An ETF is just one fund that you buy, and by buying that one fund, you get access to everything that it invests in. There are a wide variety of ETFs available for investors to choose from, depending on their investment goals and risk tolerance. Some examples include 1. Stock ETFs. These ETFs hold a basket of individual stocks and are designed to track a specific stock market index, such as the S&P 500 or the Nasdaq. 2. Bond ETFs. These ETFs hold a collection of bonds and are designed to track a specific bond market index, such as the Barclays US Aggregate Bond Index. 3. Commodity ETFs. These ETFs hold physical commodities such as gold or oil or futures contracts on commodities. For 2023, I'd like to see 40% of my overall portfolio in ETFs. So, for example, if I had a $10,000 portfolio, $4,000 of those dollars would be in ETFs. Blue chip stocks are shares of large, well-established companies that have a strong track record of financial performance and stability. These companies are considered to be among the most reliable and trustworthy investments. Some examples of blue chip stocks include Apple, Microsoft, and Amazon. These are the stocks that are going to remain stable over a long period of time. And generally, when you're thinking about a blue chip stock, you should think to yourself that this company will still be around in 20 to 40 years. These are going to be companies that complement your ETFs and also anchor your portfolio and allow you to capture some upside more than just a traditional market. Apple, for example, has been killing it in the past 5 years and is up around 240%. If you are going to pick some blue chip stocks, you definitely want to do your due diligence. So don't just basically blindly pick a blue chip stock like Google or Apple. You want to make sure you look into their balance sheet and make sure it looks healthy. You want to make sure they're earning profits, and you want to make sure that the management team is solid. So for this allocation, I'm putting 20% of my overall portfolio into blue chip stock. So that means if my portfolio was worth $10,000, I would have $2,000 of those dollars allocated to buying different types of blue chip stocks. Alright, so if you're still with me, so far, we have gone over 90% of our portfolio, which means that we're almost done. So far, we have 30% cash, 40% for ETFs, and 20% for blue chip stocks. But what do we do with that last 10%? This last 10%, in my opinion, is a little bit more flexible depending on your age. So if you're on the younger side, I would actually lean towards growth stocks and more speculative stocks. But if you're on the older side, you should probably be leaning more towards fixed income. Now, you're probably wondering why only 10% into growth stocks. So let's talk about this scenario. Growth stocks tend to suffer in higher interest rate environments because that means it's going to cost more to borrow money, since a lot of growth stocks are unprofitable and they highly leverage debt and borrowing. This means that as interest rates go up, the cost to borrow increases. So if a company is less profitable, they are going to have less in free cash flow. And that's a large factor in how growth stocks are valued, which means the stock price will tend to drop. If you're on the older side and you want some more of that fixed income and more stability in your portfolio, then you can put this 10% allocation into bonds instead of growth stocks. And there you have it, the ultimate investing plan for 2023. 2023. By following this plan, you'll be on your way to reaching your financial goals and securing your financial future. Now, you should remember that this portfolio is not one size fits all. It's more just a mere suggestion of what I would do if I was between the ages of 18 and 40 and had a pretty stable salary. Remember, investing is a marathon, not a sprint, so stay consistent and stay the course. Don't forget to share this video with your friends and family. Who knows, you might just be helping them create their ultimate investing plan too. And if you found this video useful, be sure to like, comment, and subscribe, and I'll see you next time.